All right, let's talk about one of the hottest corners of the investing world right now, option income ETFs. I mean, they're everywhere, but who are the big players, and what's the real difference between them? That's what we're going to do today. We're going to take a tour of the whole landscape and really break down what makes each of these guys tick. So let's get into it.
So here's the big question, right? The multi-trillion-dollar question that's probably on your mind too. In a market that feels like it's changing every single day, where on earth do you find steady, reliable income? I mean, that hunt is more intense than it's ever been. And that's exactly the problem that this new generation of funds is built to solve.
And here's the big idea. At its core, it's pretty straightforward. Think of it like this. These funds own a bunch of stocks, right? But then they do something extra. They sell options on those stocks, which brings in more cash. And that extra cash, that gets paid out to you, the investor, as income. The whole goal is just to create that steady paycheck month after month.
So who's actually running the show here? Let's start our tour in the US, because this is where you'll find a handful of massive firms that have really come to dominate the space. And what's interesting is, each one has its own unique flavor, its own way of doing things.
And look, when I say giants, I am not kidding. Just to give you a little perspective, two of the firms we're about to talk about, JPMorgan and BlackRock, they manage a combined, wait for it, $12 trillion in assets. This isn't some tiny niche corner of the market. This is the big leagues, for sure.
Okay, first up, JPMorgan. In what's become a really crowded field, these guys have somehow managed to become the name. When you think of success in this space, you pretty much think of them. They've truly emerged as an absolute powerhouse.
So, what's their secret sauce? Well, it really comes down to their strategy. See, instead of just selling plain vanilla options, they use these custom-built things called equity-linked notes, or ELNs for short. This just gives them a ton more flexibility in how they generate income. And this unique structure? It's been a massive hit with their big funds, JPI and JPQ. You want to know how popular? JPI, all by itself, has just vacuumed up more than $40 billion in assets. I mean, that makes it the undisputed king of this entire category. It's incredible.
All right, next on our list is Global X. And I like this comparison. If JPMorgan is the king right now, you could say Global X is one of the OGs, the original pioneers who pretty much built the kingdom in the first place.
Now, their approach is totally different. It's very systematic, very straightforward. What they do is they take a huge index like the NASDAQ 100 for their super famous fund QYLD, and they just write calls on it, month in and month out, like clockwork, no fuss. And they're really known for their whole lineup of these funds, which have become their signature thing, especially because they often deliver those, eye-popping double-digit yields that get everyone's attention.
Okay, next up is a name you definitely know, BlackRock. We're talking about the largest asset manager on the entire planet. But what's really interesting here is that their approach to this whole income game is, well, it's a lot more conservative than the others.
Yeah, the key to their strategy is really nuance. See, unlike some of the others that go all in and write calls on their entire portfolio, BlackRock's iShares funds usually only do it on a portion of the index. Their goal isn't to squeeze out every last drop of income no matter the cost. It's all about finding a balance, getting you some nice income, but with less of the wild swings. This is really for the kind of investor who wants to kind of dip their toe in the water, not dive headfirst into the deep end. And of course, you can't have a conversation about Wall Street Titans without bringing up Goldman Sachs. Now, they're a little newer to this particular game, but wow, have they come into this market fast. We're talking incredible speed and, frankly, a lot of aggression.
And their growth just proves how much demand there is out there. Their main funds, GPIX and GPIQ, they kind of follow a similar playbook to JPMorgan's. And the market has absolutely eaten it up. Get this, both funds blew past the billion-dollar mark in assets in under 2 years. That kind of insane growth tells you one thing. Investors are hungry for this kind of strategy.
Okay, let's pack our bags and take our tour north of the border for a minute, because Canada, you might be surprised to hear, has a really mature and well-developed market for these income ETFs. They've got their own whole set of leaders up there. This gives us a really nice little snapshot of the Canadian scene. You've got BMO, who's basically the market leader. Their covered call ETFs on Canadian banks, they're an absolute staple for investors up there. Then you have CI Global Asset Management, and they tend to focus more on the big global tech giants. Harvest, they've carved out a cool little niche for themselves by really focusing on simplicity and growth for the everyday investor. And then there's Horizons, who are kind of known as the innovators. They're often the first ones to bring new strategies to the market.
Okay, so we've seen the giants, we've seen the big, established players up in Canada. But sometimes the most exciting stuff, the real cutting-edge developments, come from the smaller, more specialized firms, the ones who are really pushing the boundaries of what these strategies can even do.
And right away, we see two totally different ways to innovate. On one hand, you've got firms like VistaShares. They get into these complex, synthetic strategies, which basically just means they're using options to act like they own the stock without actually owning it. It's complicated stuff. And then on the other side of the spectrum, you have YieldMax, and their approach is radically different, much more direct.
Let's zoom in on YieldMax for a second, because man, they have really captured the attention of let's say a specific kind of investor. Their entire model is about one thing, cranking the yield up to the max. But, and this is a big but, it comes with a very, very clear trade-off.
And this is where things get laser-focused. Instead of tracking a big, broad index, a YieldMax fund like TSLY focuses only on Tesla. And APLY, you guessed it, only on Apple. The whole game is to use options to squeeze out absolutely massive monthly distributions from just one single stock. So it's pretty obvious who this is for, right? This is for an investor who gets it, who understands the risk of betting on a single company, and is willing to take on that concentrated risk for a shot at those huge rewards.
All right, we've been all over the map, so let's zoom out for a second and put all the pieces together. When you step back and look at the whole landscape, what's the big picture? How do you map this all out in your head?
It really just boils down to three main groups. First, you've got the U.S. Titans, your JPMorgans, your BlackRocks. They're all about unmatched scale and market dominance. Then you have Canada's leaders. They're defined by their deep expertise in a really well-developed market. And finally, you've got the niche innovators, the YieldMaxes of the world, who are all about pushing the envelope with these high-yield, high-risk ideas.
And that really gets to the heart of it all, doesn't it? Because of this explosion of different funds, there's pretty much something for every kind of income investor out there now. I mean, the menu is huge. It caters to everyone, from the super conservative income seeker all the way to the person who's willing to take on that concentrated risk for a shot at those huge payouts.
And that brings us to the final big question. As all these firms keep innovating, keep competing for your dollars, where is this all going? This push for higher and higher income, it feels relentless. But you have to ask, at what point does the push for higher income just become a push for higher risk? And that right there is the key question that's going to shape the entire future of this space. Something to think about.